Our next story comes from Go Banking Rates, and it notes that there were approximately 72 million baby boomers alive in the U.S. in 2019. And many of those boomers are now house poor, which means they purchased a home, but it prohibits them from affording much outside of the mortgage payment. Now, there is a general rule that says that your housing costs should not exceed 30% of your overall income. Now, when you're house poor, those costs will definitely exceed that amount. In fact, for most recent borrowers, they do. Those who are house poor do struggle to pay for their mortgage payments. Then they have property taxes, maintenance, utilities, insurance, and they may be close to not being able to afford them at all, a dangerous position. Now, why is this happening to baby boomers specifically? Here's what financial experts say is causing this generation, baby boomers, to become house poor. First is they're resistant to downsizing. They say that baby boomers who've typically seen their home appreciate over many years might develop a strong emotional attachment to their home. Reverse mortgage professionals know that well. They may resist downsizing or relocating, thinking it's an integral part of their identity or the legacy for their heirs or children. Because emotions get in the way, baby boomers do not want to give up their homes, even though they may be no longer able to bring in enough money in retirement to afford the home that they live in. So one advisor strongly recommends taking a good look at your needs before staying in a home that is no longer financially feasible. Another reason that they're house poor is that they've refinanced rather than paying off their mortgage. Over the last number of years, house prices have gone up tremendously, and one of the biggest messages portrayed in the media has been to cash out that equity and take out any money that you need for a variety of purposes, said Sebastian Jania, a director of Ontario Property Buyers. Jania said that he's seen many homeowners who did not pay off their homes for decades, and instead they took on more debt by remortgaging over and over. If those individuals had simply stayed the course of paying down their house without changing their approach, they would have had their homes paid off and would have had lots of disposable income for retirement. Another reason that boomers are house poor is that they dip into their savings just to keep their house. Now, generally speaking, your home should be paid for based on your income, even in retirement. You shouldn't have to deplete your savings every month just to try to keep your home afloat. In the end, that strategy is a ticking time bomb. The New York Times says that the high-class problem is home equity. A lot of money is tied up in folks' homes, and those who do need to tap it the most, however, may have the hardest time in doing so, says the column. Paying a mortgage is a form of a forced savings account. If you want to stay in your home, of course, you have no choice but to make those payments each and every month. But the appreciation in the home's value now equals $31.8 trillion for all households, that according to the Federal Reserve, and that's more than 3 times than it was in 2012. Saving for retirement, however, is not as easy and it's not mandatory, and some homeowners end up with a lot of home equity but little retirement savings, and that's the problem. A retirement account is relatively easy to tap and you can do so quickly, but home equity, not so much. The most obvious way that someone can tap into their home is to sell it, but for some older homeowners, that may be out of the question. The home may be just the way they want it because they built it that way and spent decades fixing it up. And there's the money. If you do have a mortgage, you're going to need to borrow to purchase your next home. Now, today's interest rates may be double your current one. There also may be capital gains on the sale of the home as well. Then there's the matter of heirs, if any. So next, do you want to refinance your mortgage and take cash out or get a home equity line of credit or HELOC? And you don't mind the high interest rates? Well, good luck with that because you're going to need a high enough income and credit score to do that. All which brings us to reverse mortgages, and the column says you generally pay off the reverse mortgage when the home is no longer your principal residence, which is true, or if the loan terms are not met. But most reject reverse mortgages. Lenders have rarely underwritten more than 100,000 federally insured reverse mortgages or HECMs in any fiscal year, and that hasn't happened since 2009. And why is that? Many remembered the scandals that involved the early reverse mortgage products when borrowers felt they were misled and surviving spouses and heirs could not keep the home. But now federal protections help clean things up, says the column. Still, reverse mortgages or something like them does seem inevitable in a nation where individuals are entirely responsible for their own retirement savings, thanks to the advent of few pensions. And it's time again for our monthly installment of Reverse Market Insights Market Minute with John McCue to learn what are the latest trends when it comes to HECM endorsements and applications and much more. John, what do you have for us this month?
Hey, Shannon, thanks for having me back again. Really appreciate it. This month, we're going to be looking at mostly March's numbers, and there's some really interesting stuff, I think, looking at this and going through these numbers. But where I kind of want to first start off again, just like I have been doing, is starting off with case number assignments, because this is our crystal ball. This is really showing us what we can be expecting, in the future. And so far, it's been pretty accurate. We've been seeing things increase. And that's because case numbers have been increasing. In fact, in March, they rose over 8% to 3,502. New equity takeout rose over 9% to 2,910. And purchase was over 21% to 194. That's up from 160 the month prior. I mean, that's one of the highest case number assignments that we've had since August of last year, in fact, and marks 3 months in a row that our purchase case numbers have gone up. Conversely, refinances finally saw a small decrease, just under 3% to 398. That's down from 409 from February. But what's really important here is that's still one of the highest that we've seen, with the exception of February, since June of last year. So it has been nearly a year, before we've seen numbers like that from in the refinances. So this is our third month of increases for case numbers assignments as well as HECM purchase. March endorsements, as we've been seeing case numbers grow month over month, it should be no surprise that we actually have seen endorsements grow in March over 8%, 8.3% to be exact, to 2,058. And in April, they rose again up 2.3% to 2,105. So as we see these case numbers, continually grow, we're seeing, the endorsements grow. Conversely, 6 of the 10 regions were up in March. Competition was down 2%. That comes out to 2 less people or 2 less lenders doing loans. Now, where this volume has been happening in March, you can see in this slide here that it has really gone from retail. Retail is up 9% in March, and wholesale is slightly down, just over 2% down to 2.3%, in fact. So retail was really driving volume in March. Finally, if we look at, I wanted to look at April lenders trends here. So 8 of the top 9, again, I'm not looking, I mean, this is top 10 I'm showing you, but Open Mortgage is in here, and Open hasn't been originating for some time. So right now, if we just look at basically 8 of the top 9, we do have 8 of them growing. So that's really great. Plaza was up 48.4% to 46 loans. Liberty was up 40.5% to 118. And Guild grew 36.8% to finish with 78 loans. Long story short here, I mean, case numbers have, month after month after month been increasing. Endorsements have been increasing month after month. We have some of these lenders that have been, struggling previously that are starting to really do really well again. So I know things are challenging given the current rate environment. It's really, really a challenge. People are needing these. It's great to see the HECM purchase number, growing. That means that we're out there, we're talking about or educating more people about that product, especially with some of the changes from HUD. So, just wanted to, give the industry some shout out and kudos. You guys are doing a great job considering. Keep at it. We'll see these things continue to grow in the future months. Thanks. We'll see you next month.
And that's a wrap for another episode of HECMWorld Weekly, bringing you the nation's only weekly podcast with reverse mortgage-related news for you, the mortgage professional. You can also listen to our audio edition, which you can find on Spotify and Apple Music and Podbean. Thanks again for joining us, and be sure to return next week for more reverse mortgage news and commentary you'll only find here at HECMWorld. Have a great week.